Chris, how are your fund managers feeling about the cycle at the moment? Because Manus and I spoke to a guest yesterday who actually sees the bottoming in the manufacturing cycle and therefore a weaker dollar. And of course, that's the impetus for risk on and some of these trades like value outperforming growth.
Well, I think there's a couple of points there. Firstly, that we've had a very extended cycle that we've talked about on many occasions, and therefore there are concerns and a worry about what are going to be the signs for the end of that cycle. And the second part of that, what are the implications of it? Does this mean we're going to see this long waited for switch from growthier assets into value assets, because we've seen the most extended rally in growth versus value since, I think, going back to the 70s. So there's a lot of managers waiting for that to happen, and we've seen a bit of that reversal over recent weeks. So I think if you're a fund manager, it's really, really tricky out there. We've just been talking about the impact on oil markets, and when oil moves by 10 or 15% in a day, that's very, very tricky if you're a fund manager and you're positioned the wrong way. So I think if you talk about it in terms of broad asset allocation, this is not the time to take excessive risk. I think this is the time to be very, is the time to have a really well broadly distributed portfolio that's still got a lot of equity bias in it, because as David Malpass was saying, you know, growth is slower, but it's not falling off a cliff, but is more cautiously distributed than it might have been when the growth outlook was more certain.
Chris, I want to get your sense of what is rational. Steve Schwartzman used the word. It's a very rich and broad church word. So translate it into this for me, because this is everyone's a winner. I won't sing the song. Stocks, bonds, commodities and currencies, all positive returns so far this year. So if I am rational, which asset class do I want to be the longest off? Because I'm going to get a Fed cut, I'm going to get QE, I'm possibly going to get a PBOC rate cut, and I might, if I'm very good for Christmas, I might get a trade deal.
Yeah, I think it's really tricky, Manus, that we would still view, and what we say to our clients is they should still have a view of taking a long-term position in equities. That should be the positive bias in their portfolios, and that trying to make these short-term timing movements is really, really tricky to get right, because we could have said at the beginning of January this year, or maybe on Christmas Eve of last year, that, oh no, all bets are off, we should be out of equities now because we're about to go into hell in a handcart because of the challenges to the global economy, and that would have been a very bad trade to do. So stick with it, stick with the equity bias in a portfolio, and that will be good for clients over the long term.
How much are you looking more now than, say, 6 months or a year ago at private markets rather than public markets in your funds?
Yeah, the answer is over more than 6 months, but definitely we are really looking at private markets. There is no question that the private market world is increasing in size, increasing in opportunity. We've just formed an arrangement with KKR, which has raised quite a lot of money for our clients over the past 6 to 9 months, and that's something that, at St James's Place, we're keen to continue, because the opportunity for the allocation to risk markets in those type of assets is, we think, over the medium to long term, really exciting.